Good morning and good afternoon, everyone, and welcome to the third in our series of webinars exploring the exposure draft general presentation and disclosures, which is a consultation document arising from the ISB's work on the primary financial statements project. The document that was published in December 2019. Just as a reminder, we had the original comment period scheduled to close 30th of June, but this has been extended to 30th of September to give stakeholders more time to consider the proposals in current circumstances of the pandemic. My name is Aida Vacenjak. I'm ISB technical staff, and I'm joined today by my colleagues Nick Barlow and Caroline Connings. So just as a reminder, we had 2 webinars already, and the recording of these webinars are available on our website as well as on our YouTube page. The first webinar provided a general overview of the proposals in the exposure draft, and the second gave a detailed look into the proposals for subtotals and categories in the statement of profit or loss. In this webinar, we will be discussing the proposals for disaggregation. Before we start, I just want to cover a few housekeeping items. The exposure draft and its accompanying documents are available on our website, and the slides we are using today will also be available for download, and the recording will be available after the session, but please allow a few days for us to put this recording up. Just want to thank again everyone for joining us today, and thank those of you who've sent us questions in advance. We will cover those at the end of our presentation, and we also invite you to submit questions at any time during this webinar. To ask a question, please just type it into the question box and press submit. Just a final reminder that the views expressed today are those of us as presenters and not necessarily those of the board or the IFRS Foundation. And now I'll hand over to Nick and Caroline to run through the presentation. And starting with Nick, maybe Nick, can you briefly tell us about overview of the project before we go into the topic of today's webinar?
Great, of course, Aida, thank you. So as we discussed in the first webinar, the objective of this project is to develop improvements in how information is communicated in the financial statements with a focus on that information included in the statement of profit or loss. The proposals in the exposure draft respond to strong messages the board heard from investors through the agenda consultation and outreach during its development. So the proposals respond to 3 main messages that we got from investors. The first message being that investors wanted more comparability in the statement of profit or loss. And to address this concern, the board proposes to require defined subtotals in the statement of profit or loss, which we covered in the last webinar. The second was a concern about the quality of disaggregation in the financial statements, including disclosures of unusual income and expenses, and that's what we'll be discussing in today's webinar. And then the third message from investors was about the need for more transparency and discipline for management-defined performance measures or non-GAAP information. And we will discuss in detail those proposals in a future webinar. So let's move on to today's topic, and we can see here that the exposure draft includes a number of proposals to address the demands for improvements in disaggregation. And today we're going to explore in more detail the key aspects of the proposals, which include general guidance on disaggregation decisions, including roles of the notes in the primary financial statements, strengthened requirements on the presentation of operating expenses, and disclosures of unusual income and expenses. So let's start with the proposed guidance on aggregation and disaggregation. Caroline, could you tell us about what the board's proposals are here?
Sure. So the first piece of additional guidance that the board is proposing is on the different roles of the primary financial statements and the notes. Now, these roles are meant to help companies decide whether to put information in the primary financial statements or in the notes. And the guidance makes it clear that the primary financial statements are intended to be a structured and comparable summary, with the notes providing additional details necessary to understand those primary financial statements, as well as provide supplementary information necessary to meet the objective of financial statements.
Now, as well as this, the board is also proposing some new minimum line items in addition to those already required by IS1. Caroline, could you explain what those are and why they are being proposed?
Of course. So in support of the proposals that we discussed in the last webinar on subtotals and categories, the board is proposing to require separate line items in the primary financial statements for integral and non-integral associates and joint ventures. And those new line items will effectively replace the previous line items we had in those statements for associates and joint ventures accounted for using the equity method. And then similarly, the board is also proposing that income and expenses from financing activities are presented as a minimum line item, and that would replace the existing minimum line item for finance costs. And then finally, consistent with our proposed guidance on disaggregation, the board is proposing goodwill as a minimum line item in the balance sheet. And that's because goodwill is considered to have significantly different characteristics from intangible assets, with which it's often aggregated today. Then next, the board also proposes principles of aggregation and disaggregation, which specify that items should be classified and aggregated based on shared characteristics. And so those items that share characteristics should be grouped together, and those that do not share characteristics should be separated.
So that seems to make sense as general principles, but could you give us an example of how they might be applied in practice?
Sure. So, for example, if we look at investments in financial assets, you could disaggregate those using the characteristic of their measurement basis. So for example, financial assets measured at fair value through profit or loss could be provided separately from other measurement bases. And then those financial assets could be even disaggregated further on the characteristic of their exposure to different risks. So for example, the amount of financial assets measured at fair value through profit or loss that are equity instruments could be disclosed separately from those that are debt instruments on that basis. Now, such decisions on aggregation will always require judgment, and the intention with this part of the proposals is not to be prescriptive, but rather to provide a common set of principles to lead to better decisions, so not simply just more or less disaggregation or aggregation.
Now, there's also guidance that companies should use meaningful labels to avoid descriptions like other expenses or other liabilities. Does this mean the board is banning the use of the term other?
No, so banning it is not the intention with this guidance. The guidance is intended to encourage the use of more meaningful and more descriptive labels. However, we know that there are circumstances when you cannot avoid using an other label. And so in those cases, companies would be required to provide more information about the contents of these items labeled as other. So for example, when such a balance is made up of a number of immaterial items, then an entity could disclose that fact and the nature and amount of the largest item, for example, because that would give users insight into the underlying information and how the company has applied materiality. Now that we've discussed the more general guidance included in the proposals, let's move on to the detailed proposals for the analysis of operating expenses by nature or by function. Nick, could you start off by reminding us what we mean by an analysis of operating expenses?
Of course. So in this slide, we show the proposed new structure of the statement of profit and loss, which we discussed in the last webinar. We've highlighted here the analysis of expenses within the operating section. This example shows an analysis of operating expenses by nature, which means expenses are presented by the type of inputs such as raw materials, employee benefits, depreciation, or amortization. Alternatively, expenses could be analyzed by function, which means the expenses are allocated to the functions within the business, such as cost of sales, selling, general and administration, or research and development. We'll see examples of this later on.
Now, there are already requirements in IS1 on providing an analysis of operating expenses today, but Nick, could you explain how the board is proposing to strengthen these existing requirements?
Sure. So there are several elements to what the board is proposing. The first is that the analysis of expenses is required to be presented in the statement of profit or loss, so not only in the notes. Next, the analysis will need to be presented using either the nature of expense method or the function of expense method, whichever one provides the most useful information. So by this, the board is making it clear that the method of analysis is not a free choice. And then finally, it also means that companies may not provide an analysis that mixes elements from a by nature and a by function method of analysis.
And could you explain how a company is supposed to determine whether a nature of expense or a function of expense method is the most useful?
Sure. So the board has proposed some factors to help companies to judge which method would be the most useful. The first factor is which method will provide better information about the key drivers of the company's profitability. So for example, a manufacturing company might have a key driver of profitability that is the amount by which the revenue exceeds the direct cost of earning that revenue, which would be represented by the cost of sales. That would suggest a function of expense method would provide the useful information. In contrast to that, you could have a company that provides services and doesn't have the same direct link between certain expenses and revenues, and using the nature of expense method in this case may be more relevant. So a second factor would be which method most closely represents the way the business is managed and how management reports internally. A third factor being proposed is industry practice. And then finally, if a company needed to make an arbitrary allocation of expenses to analyze by function, then the nature of expense method would be required.
Okay, so once a company has determined the most useful method of presentation, the proposal requires that it must use that presentation alone and not mix elements of by nature and by function. So I understand that today many companies are using a mix. Could you explain why the board is proposing to prohibit such presentation?
Of course. So the issue that the board is trying to address is the problem of completeness of expenses presented in a statement of profit or loss when that mixed presentation is used. So if we look at an example, as shown in the slide, here we have a company that presents its operating expenses using the function of expense analysis. So with a cost of sales line item, research and development line item, and a general and administration line item. If it then also presents a line item using the nature of expense methods such as depreciation, as in this example, it becomes unclear whether this entity includes some depreciation expense which is related to manufacturing of goods in the cost of sales line item, leaving depreciation incomplete, or includes that depreciation in the depreciation line item, leaving cost of sales incomplete. Either way, the resulting presentation includes an incomplete line item. And this can become more problematic when companies make different decisions and then peg these items electronically. When investors try to compare them, they have no way to know if they're comparing apples to apples.
Okay, so I understand that, but then the exposure draft carries forward requirements for minimum line items to be presented in the statement of profit or loss. And many of those minimum line items are by nature items, such as impairment losses under IFRS 9, which is the financial instrument standard. Now, for a company that determines that the most useful method is by function, how would that interact with those minimum line item requirements, given that there's a ban on mixed presentation?
So the board is proposing that the ban on the mixed nature and function wouldn't apply to presentation of minimum line items. The same uncertainty for these line items about what may or may not have been allocated does not arise for minimum line items because they are already required to be presented as complete line items within a category. So it is clear that no portion has been allocated within that category. So even if an entity is using a by function analysis in the statement of financial performance, it would be required to present a separate line item of impairment losses under IFRS 9, even though that's a by nature item. And we can see this in the example on the left for impairment losses on trade receivables.
So now that we've discussed the presentation in the statement of profit or loss, could you explain the proposed disclosure requirements in the notes?
Of course. So users told us that they want information on expenses by nature for all companies because they say it provides a better basis for forecasting than expenses by function. They say that the information about expenses by nature also helps them to understand the link between the statement of profit or loss and the statement of cash flows. So that is why the board proposes that if an entity presents its operating expenses in the statement of profit or loss using a by function analysis, it must provide a by nature analysis of the total operating expenses in the notes. This slide shows one possible illustration of such a case, and we can see that on the right-hand side, the notes by nature.
Now, we have already heard some concerns from companies that this particular proposal would be very costly to implement. For example, some companies are telling us that their systems don't retain information about the nature of costs when they're capitalized into inventory. So how is the board proposing to address these concerns?
Well, the board was aware of preparers' concerns during its development of the proposal. the message from users was that the most useful information for them would be detailed breakdown of the expenses by nature, including within each functional item. But to balance the cost of that with relevant information, the board instead proposed requiring a by nature disclosure at the entity level so that companies would be able to use the information available from, for example, the HR or purchasing systems to provide the items by nature. So as we can see in this example, the company doesn't need to disclose how much employee benefits are included within each function, cost of goods sold, selling expense, R&D, and general and admin. It only needs to provide an analysis of the total operating expenses. This means the entity would not have to unbundle costs such as employee benefits that have been capitalized to inventory. Instead, it will include all the employee benefits incurred during the year in the line item employee benefits, and then the employee benefits capitalized to inventories in the current year and the realization of those capitalized in the prior year would be included in the changes in inventories of finished goods and work in progress line that we can see at the top of that slide.
Now, I understand that in current practice, some companies only disclose selected amounts by nature. So for example, they would only disclose employee benefits and depreciation. So those providing selected amounts, that would no longer be allowed, right?
That's right. So companies would be required to include the full analysis of total operating expenses by nature in this note, and that would tie back to the total of operating expenses presented by function presented in the statement of profit or loss. So why don't we move on now to the final aspect of the disaggregation proposals that we'll go into detail on today, and that's unusual income and expenses. Carlene, can you tell us about the current situation in practice?
Sure. So many companies currently already disclose items that they describe as unusual, or they use similar descriptions such as non-recurring or special. And companies tend to identify such items in different ways using different definitions. Some present them in the statement of profit or loss, some disclose them in the notes, and others adjust for these unusual type items when they're calculating their management-defined performance measures.
Now, there seems to be quite a lot of diversity, but the message from investors was still that they find such information useful to their analysis. Could you explain why that is?
Sure. So investors find information about income and expenses that are not expected to recur very useful for forecasting future cash flows of a company. However, investors have expressed concerns that the way this information is provided today varies significantly between companies, and it's often not exactly clear how or why certain items have been identified as unusual. And then investors are also concerned that there is a tendency for most of these items to be expenses and not income, and this may imply that there's some management bias in what companies identify as unusual.
So how is the board proposing to address these concerns?
So what the board is proposing is to provide a definition of unusual income and expenses, which focuses on whether the income or expense has limited predictive value. And that definition is on the slide. So income and expenses are identified as unusual if it is reasonable to expect that income or expenses that are similar in type and amount will not recur for several future annual reporting periods.
So this definition focuses on what a company expects to happen in the future. Can you explain why that is?
So you're right, this definition is forward-looking, and that may be different to how some identify unusual or similar items in current practice. So the proposed definition aims to meet the objective of identifying those items that have limited predictive value, rather than something that just hasn't happened before. Now, companies might consider past occurrence of income or expenses when assessing whether it's reasonable to expect they will occur in the future, but past occurrence is not a decisive factor in the definition.
So does that mean that even if similar income or expenses have arisen in the past, if an entity thinks for some reason such income or expense will not arise in the future for several periods, they could meet the definition of unusual?
Yes, that's right. So we have an example here on this slide on the first row. So in that example, let's say in the current period, a company has incurred an impairment loss of $2,500 resulting from a fire at one of its factories. Now, 2 years ago, it also had to recognize a similar impairment loss due to an unrelated incident in another factory. But despite this past occurrence, the company identifies the impairment in the current period as an unusual expense if it has a reasonable expectation that it will not suffer a similar impairment loss for several future annual reporting periods.
Now, what about, say, something like a restructuring that hasn't happened before? Could such expenses be classified as unusual?
So again, the past occurrence, or in this case, the lack of occurrence by itself is not a decisive factor. So if it's reasonable to assume that similar expenses will not arise in several future annual reporting periods, then the expenses would be considered unusual. However, let's look at the example in the second row on the slide, which is meant to illustrate a scenario in which an entity is in the first year of a planned 3-year restructuring program. And in this case, even though the program is only expected to affect a finite period, the expenses in the current period would not meet the definition of unusual if expenses of a similar amount are expected in the next period. However, if on the other hand, the future expenses are expected to be significantly lower than the expenses in the current period, then the expenses in the current period could meet the definition of unusual.
So does this mean that expenses of a type that a company incurs regularly, say litigation expenses, could never be unusual?
So not necessarily. Income and expenses that are not unusual in type may be unusual in amount. So the third and final example on this slide illustrates a scenario in which a company incurs regular litigation costs that are all of a similar amount. So in this example, they're between 300 and 550. So the company would not generally classify those litigation expenses as unusual. However, if in the current reporting period, the company incurred high litigation costs of 2,500 because of a particular important case, it would classify the costs from that case as unusual if litigation costs in several future annual reporting periods were not expected to be of a similar amount. However, it is important to note that companies will need to consider the amount of variability that can be reasonably expected to determine whether items are unusual in amount. So items that are remeasured at fair value each reporting period, for example, can experience large variances in amount on a regular basis, and this needs to be considered in the judgment about what is reasonably expected. For that reason, the board is proposing that income and expenses from the recurring remeasurement of items measured at a current value would not normally be identified as unusual. Now, Nick, can you explain the proposed disclosure requirements for unusual income and expenses?
Sure. So companies will need to provide some narrative description about unusual income and expenses and the underlying transactions or other events that made them unusual. Companies would also be required to disclose unusual income and expenses by the line items in the statement of profit or loss. So if an entity uses a by function analysis in a statement of profit or loss, the disclosure could look like the first table on the slide. In addition, if the entity uses a by function analysis in the statement of profit or loss, it would also be required to disclose the unusual income and expenses included in operating expenses analyzed by nature. So the example of that disclosure is shown in the second table on the bottom in gray.
Now, what would happen if an entity uses by nature in the P&L?
Then the entity would only need to disclose unusual income and expenses disaggregated by the line items in the statement of profit or loss, which would include operating expenses by nature. It does not need to provide a by function information analysis.
Now, I understand this by nature, by function distinction is only applicable to operating expenses, but do we expect unusual income or expenses would always only be included in the operating category?
Well, not necessarily. Companies would classify income and expenses into categories following the definitions of each category, as we discussed in the last webinar. Whether income and expenses are unusual does not affect the classification itself. So unusual income and expenses could be included not only in the operating category, but also in the other categories, such as financing or integral associates and joint ventures.
Now, in the illustrative examples that accompany the exposure draft, there is an example where we've combined unusual items and management performance measures in a single note. But does that mean that the board expects that many companies would adjust for unusual items when they calculate their management performance measures, or that these two disclosures should be combined whenever possible?
So again, not necessarily. The board's aware that some companies are adjusting unusual items and expenses in calculating management performance measures, but they neither discourage nor encourage such adjustments. There are separate disclosure requirements for unusual income and expenses and separate disclosure requirements for management performance measures. However, if an entity adjusts for all unusual income and expenses when calculating its management performance measures, it could combine the two note disclosures, provided that all the necessary information is provided in a clear and understandable way.
Well, thank you, Nick, and hopefully that clarifies some things for those participating today. So now let's move on and see if we can answer some specific questions that participants have sent us. Aida, did you want to introduce the first question?
Thank you, Colleen, and thank you, Nick, for this presentation, and thank you to all participants who've been sending questions in. And we have quite a lot of questions received. We will try to cover as many as we can. I just want to highlight, I can see some of the questions are on the topics that we are not discussing today. So I will give those less of a priority, and we'll see if we have time at the end to cover them. If not, please make sure that we will consider them as a team afterwards. So just a reminder, there is still time if you want to ask any more questions. And also, I'm just going to share a few questions with you as well, because we are interested in your thoughts on some of these topics we covered today. So if you would like to do a survey that I've just shared whilst we're answering questions. So let's look at the questions here. And Nick, we had a question from participants saying the ISB seems to clearly favor analysis of expenses by nature, and wonders why that is.
Sure, so I can see how that view may come across. But the board isn't particularly prioritizing it. It's certainly not proposing to eliminate the analysis by function. It acknowledges that this also provides useful information. For example, it can facilitate the calculation of some performance metrics and margin analysis. However, these proposals are responding to messages we heard from users, and that was, as we discussed earlier, that the nature of expense method of presentation is useful for all companies. There was no similar demand for the by function for all companies, and the board also recognizes that in some cases this could be challenging for a company that presents by nature and doesn't manage on a by function basis of analysis, and it could result in arbitrary allocations or creation of functions that don't really exist for that entity. On the flip side, though, the expenses always have a nature at the source of the expense, even if that information might not be readily available.
Thank you, Nick. And Colleen, it's a question quite related to this one, and is asking, it's clear that there is a requirement to disclose analysis of expenses by nature if entity reports by function, and there is no equivalent requirement for those that report by nature. And the question is whether those that report by nature could voluntarily disclose information about expenses by functions in the notes to the financial statements.
Sure, I think there would be nothing in the requirements that prohibits that. So if that analysis is made on a reasonable basis, and if it adds useful information, then I can see no reason why a company would not be allowed to present such information in the notes.
Thank you, Colleen. And let's look at a question regarding the analysis, disaggregation, and specific question on items labeled as other. And our participants was a bit unclear actually how it would be practical for entities to implement this proposal regarding items labeled as other. Maybe, Nick, it will be useful to just walk through again what the board intended with this guidance.
Sure. So the purpose of the avoiding or not necessarily avoiding, but trying to give more information about other. It's really about giving more transparency about what's collected in those items. We heard feedback that sometimes those items can collect to be quite large balances, and without further information, as we mentioned in the presentation, it's not clear necessarily how materiality has been applied. It's quite opaque what's in that balance. The idea is to give more transparency, and the example that's been provided is just to give a list of the types of items that are included, potentially disclosing what the amount and nature of the largest item is, and that's to give the users of the accounts who don't have the same insight into what's gone into that preparation and the application of materiality, an understanding of what's in that balance, and gives them a better basis to be able to evaluate and understand it.
Thank you very much, Nick. And let's look at a couple of questions on the unusual. And there is a question I think we receive this quite often, comparing with previous guidance that used to be in IFRS standards on extraordinary items that are now prohibited. And the question is around interaction between guidance on unusual versus this extraordinary. Nick, do you want to cover this as well?
Sure. So it's always worth highlighting that these are quite distinct concepts. And we know IFRS standards previously required a presentation of extraordinary items, but this was an after-tax amount in a separate category of the statement of profit or loss. And this was eliminated back in 2002, and the board concluded that these extraordinary items didn't warrant such a separate presentation, and so that presentation for extraordinary items was prohibited. With the board's proposals for unusual, these would not be presented as a separate category in the statement of profit or loss. Instead, all the items that might be considered unusual are presented together with usual income expenses in their respective categories, and those are allocated to the categories based on other characteristics such as the nature or their function. But then, as we explained earlier, the unusual items would be separately identified and explained in a separate note disclosure.
Thank you so much, Nick. And Caroline, just carrying on this theme of unusual, we have a quite specific question here, and the question is, do litigation costs meet definition of unusual expense? Would you like to comment on that?
Yeah, so I think we had an example in the slides as well where we showed that litigation expenses could be unusual if, for example, in a particular period you had an unusually large amount of litigation expenses. So the fact that you actually have litigation expenses every period doesn't preclude you from identifying it as unusual in.
Thank you, Caroline. I can't hear Caroline, but hopefully you can still hear me. And let's look at some other questions that have arrived here. So I can see a couple of questions following on the nature function, and it's quite similar to previous, but I think still may be useful to clarify. And maybe you can take this, Nick. I just want to check you're still with us online, Nick.
I'm still here.
Okay, great. So the question is really relating to selection of by nature or by function method, and asking about circumstances where a particular method is required for local regulatory purposes, and whether this requirement could mean that companies would choose that method for financial reporting purposes as well. So if you want to comment on that, maybe.
Sure. So I think as the exposure draft is written, entities would still be required to do the analysis. I think that our expectation is be rare that there would be a conflict. However, we are currently going through a process of field testing and understanding how some of these conclusions might interact with the legislation, and we'll also have to evaluate the results of that and consider whether there are conflicts.
Thank you so much, Nick. And indeed, as you mentioned, we are going through field work. We have quite a lot of companies participating in this at the moment, and some of them have actually concluded the exercise. And actually, I remember one at least telling us that they find presentation by function most useful in their circumstances. So they use this presentation in the income statement, but they have a local regulation that requires presentation by nature. So they simply provide this information as well already today in full. So it seems that they didn't take conclusion that because local regulation requires it, that this is the most useful necessarily in their case. And then another question, it's again about selection between nature and function. And the question is, because we use the word shall in the indicators, talking about when we talk about allocation by function being arbitrary, does this mean that this arbitrary indicator is conclusive, and therefore if the allocation is arbitrary, means company shall not present by function? Nick, did you want to comment on that as well?
Yes, I think that is a correct interpretation. The idea is that if an entity needs to make arbitrary allocations, then the by function method of analysis is not the one that's going to provide the most useful information. And so it's very much an attempt to avoid those kind of arbitrary allocations that are not useful.
Thank you, Nick. I'm just going to check if Colin is back online with us yet.
Can you hear me now?
Oh, we can hear you. Yeah, welcome back. So we talked a bit more about analysis of expenses by nature and by function, but here's a couple of more questions on unusual income and expenses. So one question is, do the proposals require companies to provide information about tax relating to unusual income and expenses? Do you want to comment on this, Karin?
Yes, sure. So there's no such requirement for unusual items, but there is such a requirement for any adjustments that you make in your management performance measures. So for any reconciling items between your management performance measures and the closest IFRS subtotal, you need to provide information on tax and NCI. And of course, it is possible and even expected that some companies will adjust for unusual items in their management performance measures. So companies might end up having to disclose tax effects on unusual items, but that's because of the requirement that would exist for MPMs.
Thank you so much, Colin, for clarifying that. So we have a few more questions around unusual, and maybe you can carry on with this, Colin. So we have a question that just come in and asking why can't unusual income and expenses be presented on the face of the income statement and are only disclosed in the notes?
So first, I'd like to clarify that we don't have a specific ban on presenting unusual items separately. The only requirement that we have is that those items can only be presented on the face if they fit into the structure, the new structure that we're proposing for the face. So they would have to fit within the categories that we're proposing, and also they can't disrupt an analysis by nature or by function. But if those conditions are met, then you would be allowed to put unusual items on the face. But we expect that because of those restrictions, those circumstances might actually be quite limited when you can present them on the face.
Thank you very much. And it's we have a few more questions around unusual. Some are quite long, and I'm just going through them. So another question, and maybe you can carry on with this theme, Karin. It's about unusual income and expenses and remeasurements, and referring to the proposed requirements in the ED, which states that remeasurements and current value would not normally be classified as unusual income and expenses. And it says it is not clear when such remeasurements could be classified as unusual because the range that might be used is quite wide, and it's not clear that if this condition could ever be met. Do you want to comment on this, Karin?
I think we expect it to be rather rare that such items would ever be unusual, but we don't say that it's never possible. So I think you would consider the range of variability that you would normally expect, and if it's really outside that range, then it could be unusual. But as I said, I think it would be rather rare.
And indeed, as you say, Caroline, I think we are unfortunately maybe experiencing one of those rare occasions right now, and I think I can see possibly that some of the remeasurements arising in reporting period covering this year could as well meet this definition, because even though the expected range is wide, this might still be beyond that range. But again, it's a question of a judgment and assessment of whether this is really outside expected. And also, I think the question here, as we mentioned during the presentation, is also depends on your expectation for the future. So even if you had something beyond your expected range, if you think that this might continue going forward, then it's unlikely then that it would meet definition of unusual income and expense. And Nick, carrying on the theme of unusual, and there is some questions around difficulties with judgment, and then we have a participant commenting that the concept of limited predictive value is difficult to apply, and stating opinion that more guidance might be needed. And maybe do you want to comment on this a little bit?
Sure. So I think the limited predictive value piece, I can see how that's quite judgmental. The definition itself tries to narrow that to a more specific subset, those that are not expected to recur for several future reporting periods. Now, there are some elements of judgment within that. For example, what is the time period to look at? But the board is trying to strike a balance here to not be too prescriptive, such that you get unexpected outcomes simply by virtue of something being 1 year versus 3 years versus 5 years, for example. However, there's hope that there's sufficient guidance there to be able, particularly with the examples that are provided, to help make those judgments. I think the board also took into account that many entities today, as we explained in the presentation, are identifying unusual items and making similar judgments today, just on a different definition. So there's sort of an equivalent idea here that these types of judgments are possible to make, and I think there's sort of a balance here to be found between being very prescriptive about what those items are and giving management the ability to exercise judgment in what those are.
Thank you so much, Nick. And just like you said, it's important to note that proposed definition of unusual income and expense doesn't end with limited predictive value. So we have a specific definition of what the board means with limited predictive value. So it's not entirely left to judgment as to what limited predictive value is, but as Nick said, there are further judgments then to be made as what is reasonable expectation and what is several future reporting periods and what's similar in type and amount, and so on. But I'm certainly encouraged so far by the results of our fieldwork exercise with companies. Although they had to make judgments, it seems that they were able to make them, and they were able to identify if they had any unusual income and expenses and what those were. So carries on with the unusual. I think we have a now specific COVID question, and asking, would you say the COVID-19 impact would meet the definition of unusual? And Karin, do you want to comment on this one?
Sure. So I think an entity would need to apply the definition. And so if there are expenses in the period that you expect that would recur for a number of future periods, then it wouldn't meet the definition of unusual. But as you said, there would be probably a number of expenses that could be considered unusual, like, as you say, some fair value measurements or particularly large impairments in the period that could maybe meet the definition. However, we think that not the whole impact of COVID could be captured by our definition of unusual items. There will also be, for example, lost revenue, and because it's a hypothetical amount, it couldn't be captured by our definition of unusual. So unusual items wouldn't really provide a full picture of the impact of COVID. So we think entities could potentially would need to use other maybe narrative descriptions to provide a more faithful representation of the impact.
Absolutely right. Thank you so much, Karin, for clarifying that. We have a couple of questions on things that we haven't, I don't think, explicitly addressed, and we have one interesting one dealing with companies that have multiple main business activities and asking if it is possible to present kind of two operating sections on the face of the profit or loss covering these separate activities and to use different methods of analysis of expenses in these two. And similarly, for the different combinations of activities. And just to say, currently as the exposure draft is drafted, this would not be permitted because it says at entity level there shall be one method used. But I'm really interested in feedback on this because I can see the situations when company has two distinct activities and it is clear for one activity that the nature provides most useful information, for the other the function provides most useful information, and we have had questions around what to do in that case. And it's also a question around, even if they were to do a single method, how would they then make these decisions if these two activities are equally important to entities? So I think that's really interesting questions, and I don't know if a commentator who asked this question is from a company that has this scenario and that maybe submit a comment letter, but I think we were certainly interested in you elaborating on that and perhaps suggesting what you think could be a way forward to enable such companies to provide best information possible. I think we have here, going back to or continuing with the theme of nature function, we have a comment that the requirements really should go both ways. And I think we covered that during the presentation, why the board is not proposing to have a requirement to disclose expenses by function in the notes. But given that this is common questions, Nick, I wonder whether it is worthwhile just to reiterate this point again for our participants today.
Sure. So as you say, to reiterate, the requirement to disclose by nature in the notes when a function of expense is in the statement of profit or loss is really driven by the user demand for that information. And we didn't have that same demand or the same strength of demand, at least for having functional information. And in addition to that, in some cases, for a company that produces by nature statement of profit or loss, creating a by function analysis can become quite arbitrary because it doesn't analyze by that way, and not all expenses have a by function allocation, whereas by nature all expenses do have a nature of expense. And so, I mean, as we mentioned, there is an appreciation that this may incur additional costs where that information is not readily available, but it doesn't make sense necessarily to impose that same cost for information that is not useful or there's not a demand for, and so there's not this equal treatment between the two.
Thank you so much, Nick, and I'm afraid I'm going to have to stop answering questions. We already overrun a little bit, and I'd like to also spend a couple of minutes showing you the results of our survey, which and maybe provide some comments on that. So I hope you can all see it now on your screen. And just to maybe comment, let's look at the question 2. So the question 2 was around proposal to prohibit mixing expenses by nature and function. And it seems that the majority of participants today actually agreed with proposals, and some were unsure, and others thought that there would be additional limited circumstances where mixing would be allowed. So it seems that there's the fewest of you today who thought that mix should be allowed always, which is kind of consistent where the board is going. But I think there is maybe some merit here to exploring whether there's a room to consider some additional line items to be presented in all circumstances. So moving on to next question, let's see what we responses are to question 3. So this is around disclosure of information about operating expenses by nature in notes when entity presents by function. And again, majority has agreed, but there was, a significant proportion of you who either were not sure or did not agree with this proposal. And as we said during the presentation, we are in the midst of field work exploring the costs of this. I think our outreach has really indicated that this information is really useful to users of financial statements, and as reiterated in our presentation. So we will seek a way to provide this, but consider the results of field work and to see if there is anything to be done with managing the costs of producing that. And then final question we have here is on the proposal for information about unusual income and expenses, and there is more, I would say, variety of views expressed here. That's kind of even split between those of you who majority seem to support the inclusion, but there is a mix between those of you who agree with proposed definitions and those of you who do not agree with definition, and then some of you were either not sure or did not think this information should be required. And I would say that it is somewhat consistent with the feedback we are getting again on the unusual items. I think the users, the investors we have spoken to have generally been supportive both of disclosure and of the proposed definition. They like definition to be narrow, to be focused on forward-looking. They don't want many items here. But similarly, we heard feedback that this leaves some items that might be seen as unusual, that cover only finite period, such as those that Caroline has been explaining during the presentation. So if perhaps there's a way to consider those as well. So certainly we will look into that feedback as we together with the comment letters as we prepare the analysis for the board. So with that, I think it's time to conclude our webinar today, and thank you again for your participation, for your questions, for taking time to answer polling and being here with us. And just a reminder that this webinar will be made available on our website along with the previous webinars, and just bear in mind it might take a few days to put this up. And we will also have a fourth and a final in this series of webinars, where we will discuss in detail the board's proposals for management performance measures. So we haven't got a date for that confirmed yet, but I expect it will be announced quite soon. So thank you very much again, and thank you, Caroline, thank you, Nick, and goodbye, everyone.